very much like value. When value starts to build on an offer watch, it's because markets are going higher. When value builds as a bid watch, it's because markets are going lower. Volume's the same kind of thing. Most volume is a continuation trade, not a reversal trade. On the odd occasion, it will be. And we start recognizing how they use the volume. So if I was to look at this chart here, would most of the volume here be bullish or bearish? Well, it depends what we define by bullish or bearish. Bearish being that the big volume comes on a down candle being bearish, or big volume comes up in an up candle being bullish. So in other words, if I put up my volume candles without any other information on that chart, take off the RGLs, even hide the price, even take away all my arrows. If I just put the AGs on the charts, only the AGs, could you tell me what direction the market's moving in? What do you think? Could you tell me with that AG on the chart, could you tell me what direction the market's moving in? Well, in hindsight, it's easy because we can obviously draw from lines to lines. But the basic rule of thumb, if we were to do this as an exercise, is I would now be able to look at that chart there and take the last red line before a blue line and draw an up move till the last blue line. Okay? And then from the last blue line to the last red line, I should be able to draw a down move. And from the last red line to the last blue line, I should be able to draw an up line. And I should be able to crisscross my charts like this. Now, you obviously know that there is one major flaw in this as a trading idea, and that is we don't know when the last red line's coming in. We don't know when the last red line's coming in, right? So in other words, I don't know that that's going to be the last blue line or the first blue line. Nobody knows. But what I'm trying to show you is whether there's any value in seeing what happens to these individual lines. That's where the art is. And obviously the science becomes being able to read the reaction to those volume areas. If this was the floor of the exchange, this is the shout that everybody hears, that brings everybody onto the screens. Everybody rushes into the markets at this stage. Everybody rushes into the markets at this stage. So when we go through this process, all I'm doing is just highlighting that everybody would be rushing into the desks at this point. And they would obviously be trying to figure out what they're going to do. You can see I'm not doing divergences in any way, shape, or form. I'm simply drawing in the directionality of these elements, right? I'm simply drawing in the current directionality of these elements. Now, does everybody understand what I've now shown you here? Let's take those off and let's see if it does have any confluence with price. Let's see if it has any confluence in any way, shape, or form with price action. Let's take a look. Does it have any confluence whatsoever with price action? Now, obviously, there's no particular art in this except to highlight that the volume does turn market at certain pivots. It tells us that if we see the volume going in a direction, it normally does give us a directional play on volume. And therefore, if we can gauge the reaction on each of these pivots, these ag candles, if you like, if we can gauge the reaction on these ags, that's where perhaps a massive step forward in understanding the relationship of the reaction phase becomes very important to us. You understand? The key to this is what my answer was when Sammy asked the question this morning. When we get an ag candle, what effectively do we do with that ag candle? Do we trade it immediately? Do we wait for whatever, et cetera, et cetera? So that's what the answer was. We wait for the react. It's the same as a level 2. If the price breaks to a high, we don't know if it's a breakout buy, if we don't know if the market maker is going to sell it. What we do know is if the market maker does sell it, then the market maker has sold it. And we can get a very easy read if we can see it. We don't know what they're going to do, but we're prepared and ready if they do it. We can see the outcomes. And we can therefore make a play based on that outcome. In other words, do they use the ag? Remember, the ag volume is just the same as the XE candles, correct? The XE candles should be ag candles because they're the time of the day where we should expect to see increases in volume, increases in liquidity. So when we get an ag candle, it's normally going to be an XE candle. It's normally going to be a level 2 liquidity. It's normally going to be a data release of some sort. And therefore, when we understand that that's the case, we can then look at that information and say, what did they do with that stuff? What did they do with that stuff? Did they buy it or did they sell it? Now, somebody said to me, they were talking about money flow in horses. It was one of the syndicate members. And he couldn't understand, one of the bets that we were putting on. And he said, we've got a big flow of cash coming in on this bet. A big flow of cash coming in on this bet. How do we know for a fact that that's not the stables? Way more cash. So somebody'd put on something like £30,000, right? Somebody put on a bet of about £30,000 on a horse. How do we know the money didn't come from the stable? How do we know the money didn't come from the yard, the trainer? How do we know the money didn't come from a jockey? How do we know that? Because as far as he's concerned, if there's £60,000 traded in that race at that stage, right? And 30,000 of it is on that horse should be currently trading at even money, right? Would you agree with that? And all the other horses should be placed in some way, shape, or form beyond that. Does everybody see the weight of money based on the positioning of the bets? It's called the over round. Anybody understand bookmakers? It's called the over round. So in other words, if I have an over round, nobody understands. Okay, let's just make sure you do understand this. It's not necessarily about betting, it's about the markets. If I take in a total money bet of 60,000 quid on a race, and there's £30,000 on one single horse, if I offer 2-to-1 odds, for example, and that horse wins, I lose a lot of money, right? Because obviously I'm going to pay out £60,000 as well as the guy's money at £30,000, and I'm only taking in 60,000, so I'll lose 30 grand, correct? I'll lose £30,000. Well, I can't afford to lose £30,000 as a bookmaker, so I don't price it at 2-to-1. I'll price it at 8-to-11. So if that horse wins, do I make money, yes or no? Yeah. So if that horse wins, I make money. So the one thing I've got to be careful of is not to let this horse win. It's very, very important I don't let this horse win. So in other words, if I'm a bookmaker and I gave 2-to-1 odds on this £30,000, do you think the bookmaker believes that that's informed cash, yes or no? Do you believe the bookmaker thinks that's informed cash? If it's 2-to-1 at £30,000? No, it looks like an absolute mug. It might be a series of mugs. It might be some big tipster in some retail platform giving out a big tip, and all of a sudden 500 members all put £1,000 each, or £500 each, or £10 each, whatever. It could be a tipster on a newspaper that suddenly gives out to all the readers a very, very big tip and says, this is the horse in the race. You're getting 2-to-1. And all those mug punters put on £30,000 in total. It could be the equivalent of, as I said, 1,000 people putting on £3 each. Some of these people have big followings like that, and they get these big bets. So when I see that in the market maker, and in this case, the bookmaker, is offering 2-to-1 on half the money, the chances are this horse has got almost no chance of winning. Almost no chance, because the market maker must know something about the other money in the other £30,000. So this is why when we see a big flow of money coming into something, and we recognize the price is 2-to-1, in other words, if I was to chart this, the price should be away down here, but the price is away up here. That's called what in charting? What is that called? It's called absorption, right? It's called absorption. So when that's called absorption, do we kind of recognize that they're taking that risk on their books? So they have a funny feeling that this is going to go up. They've got a funny feeling that odds is going to go higher. And if they think the odds is going to go higher, that means the horse is not going to win the race, right? If the odds go higher, the horse isn't going to win the race, is it? So we can start making some of these reads. In other words, if the probability is too high based on the money that's coming in, the market maker stands to lose a fortune. And we know that in general terms, the market maker doesn't lose a fortune. We know that the bookmaker doesn't lose a fortune. So if they offer great odds and there's a big flow of cash, they probably have some information that they just simply don't agree with. The chances are you're better taking the other side of that bet, joining the market maker and laying that horse at 2-to-1. Or if you don't like laying horses at 2-to-1, you could always look for whichever horse seems to be the horse that doesn't have the credentials. And there are ways of starting to recognize some of those horses. There's ways of starting to pop some of those ideas into the marketplace. And when you think about it, you think about each of these tipsters or these retail tipsters bring a lot of bets, and the market maker has a chance of adjusting the odds accordingly. There's a lot of ways you can start considering simple concepts. And it doesn't matter whether we're talking about trading or whether we're talking about anything else. It doesn't matter what else we think is likely to happen. What we've got to try and recognize is what does happen. Okay, that's all we've got to try and think about, is what does happen. What happens next? Now, as I said, there's a lot of ways to start thinking about these, and it's about recognizing that the difference is now very, very visible. I'll take a couple of screenshots and we'll maybe come back to this as a question, simply because it might be of interest in terms of why market makers do certain things at certain times. But I'll take a couple of screenshots, and then when we've got a couple of bits and things to analyze, we'll come back to it as a point of interest going forward. Hopefully it is of interest, but if it's not, you can always just put us on mute and you forget about us. We're not just necessarily talking to everybody on this one. It might just be something that catches some people's attentions.